Good morning. Good morning. It's so good to see everybody here. We're going to give it a couple minutes while we let everybody in. But thank you for joining us this morning.
Here's Andrea.
Give it a couple more minutes as people come through. What a great group of people. And so many names that we see already. A lot of our clients have joined us. Thank you so much. As we wait for people to come in, I can go ahead and tee us off and get us ready. I just wanted to first extend a huge thank you to our speakers this morning. We've got Mike Clark with the University of Kentucky. I went to Commerce Lexington and said, hey, we want to talk about economics. We want to talk about workforce trends. Who do we need to go to? And Mike was the one and only name that they pitched. So we are so lucky to have him this morning. Also, huge shout out to Bim, longtime benefit brokerage that we partner with often here at HRG, and Evan Ball, a star on their team, who's really going to share about what the benefit landscape looks like in 2026 and forward. We've seen a lot of policy and regulation changes in that space that I think will have lasting impact there. And then Andrea Beavin signing in from our team to really talk about how the economics and benefit space plays into compensation and kind of a total rewards package. So as we see a few people streaming in here, I will go ahead and just kick off an agenda for our discussion. We're going to start with Mike here first to really talk about the economic piece. Chase, if you want to hit the next slide. Evan to really talk about our benefits outlook, Andrea again to talk about comp, and then we'll have a wrap up and questions at the very end. If you have any questions that come up along the way, feel free to type those in the chat. We are recording this meeting, and a recording of the webinar will be available on our website within a couple days. We'll follow up with an email with a link to this recording on the site, as well as information for your SHRM and HRCI approval credits. And those are also at the end of our webinar today. So thank you again for joining us. And I'm going to go ahead and kick it over to Mike Clark. Thank you.
Well, good morning. It's great to be here. I really appreciate Andrea reaching out to me and asking if I'd be able to join you today. I'm always pleased to do this. So just in the way of introductions, I run the University of Kentucky Center for Business and Economic Research. We're basically kind of an applied economic research unit within the business college. We work with state and local government agencies. We work with business groups. And one of the things we do is we kind of monitor the state of the economy. And we talk with folks like you about, kind of what's going on and what it could potentially mean as we look into 2026. So just in terms of an overview real quick, what I'd like to kind of give you a sense of kind of where we see the economy. And really, when we measure the economy, we've got a lot of different ways of measuring this. And kind of what we're seeing is some mixed signals about how the economy is doing. We're actually doing well in terms of the things that we produce. We measure this through what's called gross domestic product. That's the value of the goods and services that the economy produces. That's actually been doing pretty well here lately. But our labor market has been weak. We're not seeing firms add as many workers to their payrolls as what we've seen in the past. That really seems to be slowing down. So, if we're not hiring a whole lot of people, where are we getting this strong GDP growth? As we're producing a lot, but we're really not adding a lot of people. So what's going on? Well, turns out we're actually seeing some pretty significant increases in productivity here over the last few quarters. And that means we're basically producing a lot more with fewer labor hours. The other kind of mixed messages that we're seeing, or mixed news that we're seeing in terms of how the economy is doing is, we've been fighting inflation for some time, and those inflationary pressures remain. And we think that's likely to maybe even increase a little bit as we look into the coming year. As we kind of drill down to Kentucky, we're kind of seeing a lot of the same types of stories. We've really done well in terms of our GDP growth. In fact, most recent data we have, third quarter, we actually beat the nation. So, good for Kentucky. But what we're seeing here over the last few months in terms of job growth is that really the growth has kind of stalled out. And so that's a little bit concerning as we move forward. And we're seeing kind of a similar situation in terms of the labor supply. Labor supply in Kentucky and really nationally as well has been pretty weak. We are seeing some increases, but generally that's been kind of weak. So let's start off kind of drilling into these slides, and I will tell you, I make no apologies for this. This is just the way economists are. We talk with slides. If you take our slides away, we get really quiet. So I've got too many slides. I apologize for that, but I kind of need them to be able to tell the story. So we talk about inflation. We measure this with a number of different tools. You'll sometimes hear the Consumer Price Index or the CPI reported in the news, or you might hear the Personal Consumption Expenditures Index. These are both just price indices to kind of see how prices throughout the economy are changing. And the way we do this is we basically are measuring the prices for this basket of goods. Kind of analogous to if you go to the grocery store and you put eggs and meat and some other things in there, and you got this big basket, and you're thinking about what is the price of these, not so much these individuals, but of all these things that we purchase. Well, we're doing this for the nation. Basically, we're thinking about all the things that go into this big basket that the U.S. economy purchases. And so this can be goods, groceries. This can be services like healthcare or housing services or utilities. So all these things go into it. And what you can see is that inflation has slowed down since what we were seeing around 2002, where it peaked around 9%. But it's still higher than we'd like it to be. What the Fed tries to do is get inflation down, not so much to zero, but to around 2% typically. A little bit of inflation is okay. What we want is relatively low predictable inflation. So we're still seeing that prices are increasing more quickly than we'd like them to increase. And so, the Fed has been fighting this for some time by trying to increase or keep interest rates high. But also, we're going to see some stuff in the job market that kind of makes the Fed's decisions about how it deals with inflation a bit more complicated. Where we're seeing price increases here lately, it tends to move across different types of goods and services. Food is still pretty high. In fact, if you drill down into it, what you see is beef prices. If you've been to the grocery store and bought steaks or ground beef or anything like that, you understand those prices have been increasing pretty significantly. We're seeing price increases compared to last year around 16, 17%. But price of eggs is actually down about 20% because, last year we had that bird flu that really affected the supply of poultry and eggs. And now that has passed, production has increased, supply has come up, and so prices have actually gone down. Other places where we're seeing inflationary pressures is in terms of things like electricity, housing, medical services, which will likely play into our discussion of benefits. But those are some of the areas where we're still seeing some pretty significant price increases. Let's move on to GDP. Again, GDP is basically the value of the goods and services that we produce in an economy. And we measure this both at the national level and the state level. And when I talk about real GDP, what we're doing is we're just taking out the price increases out of that. So we're trying to hold prices constant. So we're really just getting a measure of how much are we producing. And really, Kentucky, we like to think of ourselves as different, but Kentucky is actually very similar to the US. We're different in the sense that we've got some really unique signature industries, like, thoroughbred industry, the bourbon industry. Those are things that are somewhat unique to Kentucky. But really, when you look at our economy, we tend to be very much integrated into the national economy. And so we tend to move very much in step with the national economy. And you see that in these slides here. The one on the left hand is just showing kind of the trend. And you see that's growing. And on the right-hand side, what we're seeing is the rate at which we're growing. And what you can see is the most recent data is third quarter for last year. US grew at about 4.4% on an annual basis for that quarter, but Kentucky came in a bit higher at about 5.1. So in terms of the things that we're producing, we're actually doing pretty good. But I'd like to switch over to the what's going on in terms of the labor market. And we're going to spend a lot of time in the labor market because that's one of the really important aspects of the economy. one where we got a lot of data, and of course, a lot of people, rightly so, are concerned about, what's going on in terms of jobs and people's incomes. So one of the measures, we got a lot of different measures for how we look at the U.S. Labor market. One that you hear quite frequently is the unemployment rate. And what I'm showing you here is kind of the trend of the unemployment rate over time. And you can see that generally Kentucky's unemployment rate tends to run a little bit higher than the U.S. unemployment rate, usually just maybe 3 or 4 tenths of a % or something like that. But if you look kind of at the most recent data, what you see is that's kind of separated a little bit. In 2023 and 2024, we started seeing our unemployment rate rise relatively quickly. But then in 2025, it started to decline. And really here the last couple of months, we've been seeing our unemployment rate in Kentucky is pretty similar to what we've seen nationally. And I think it's really important to understand what is going into this when we talk about the unemployment rate, what exactly that means, because the unemployment rate increasing or decreasing can actually mean either a good thing or a bad thing is happening. And we have to really drill down into what's going on in terms of that data. Now, these measures come from surveys. The federal government actually goes out and contacts households, and it asks them about the people who are living in that household and whether they're working or not. And based on a number of questions, they get grouped into 3 different buckets, basically. One is if you're working, you are considered to be employed. If you're not working, but you're looking for work, that is, you're actively trying to find a job by applying for jobs or going on interviews, you're doing something over the last 4 weeks to find a job, you're considered unemployed. If you're not actively looking, you're not working, and you're not actively looking for a job, you're considered not in the labor force. Now, this can be a lot of different people, right? This could be, like my father who's retired. This could be my son who is in college. They're not in the labor force for very specific reasons. This could be someone who is staying at home and taking care of family members. But it can also be people who have left the labor market because they weren't able to find jobs. And so what we want to understand is kind of what's going on underneath these unemployment numbers. So we see the unemployment rate. What we're basically doing is we're not looking at those people who are out of the labor force. We're looking at people who are either employed or unemployed. Those 2 groups, that is, you're working or you're trying to find a job, are what we consider to be the labor force. It's kind of the supply of workers that we have available, our employers have available to hire from. And the unemployment rate comes from dividing the number of people who are unemployed by the total number of people in the labor force. And so that's what's happening here. And so I'd like to move on to the next slide to show you what's been happening in terms of the number of people in the labor force, both at the national level and at the state level. And what you can see is that that number had actually been increasing at a pretty good pace over the last few years. But in 2025, particularly in terms of the US, after an initial jump, that's mostly kind of stalled out. Same thing in terms of Kentucky. The labor force, well, it increased pretty good in 2024 and early 2025. We're not seeing much of an increase in those numbers here lately. So let's look at the next slide, if we could, please. So here what I'm doing is I'm drilling down into the most recent years of the unemployment rate. And this is really, I'm just focusing on Kentucky. So we see this increase, and now we're starting to see this decrease. And we want to understand what's going on there. Why is this actually happening? And so what I want to do is look at the next series, if you can, there we go. This is showing the number of people in the labor force. And you can see how it's changing from 1 month to the next. So you're basically seeing each bar represents the change from 1 month to the next of how many people are in the labor force. When it increases, it's telling us how many people have come into the labor force. And so what you can see is that in late 2023 and 2024, this number was going pretty good. In early 25, again, this number was growing at a pretty good pace. But in late 2025, we're not seeing much growth. Let's advance one more. Now what we're seeing is a change in the number of people who are employed. So if we're looking at 2024, what you're seeing is a lot of people were coming into the labor force, and they were finding jobs. And so, that number of people who was employed was actually increasing. So that was kind of a really good thing, right? We're seeing people come back into the labor force, and many of them were finding jobs, but they were coming back into the labor force much more quickly than they were finding jobs. So our unemployment rate went up. In 2025, the situation has changed. We were seeing fewer people coming into the labor force, but on the positive side, what we were seeing is that a lot of people were reporting that they were finding work. So fewer people coming in and more people finding jobs mean the number of people who are unemployed was going down. We can see that in the next series. And so what was happening is in 2025, the unemployment rate was going down because even though we weren't having a lot of people coming into the labor force, they were continuing to find work. Now, again, that kind of has changed a little bit, over the last half of 2025. We're seeing some positive numbers, some negative numbers, but, it hasn't been as consistent as what we've seen over the past couple of years. So that's kind of the situation. So what we're seeing is, again, that labor force is really slowing down. So that supply of labor is becoming a bit more restrictive, not growing the way it had been. But we are seeing that we seem to have more people working, which is a good thing. Okay, let's move on to the next slide. Now, what I was showing you was data from that survey of households, but we also survey businesses as well. And so we're asking them basically, how many people do you have on your payrolls? And of course, this is really more of a count of jobs. It is counting people, but it's counting jobs because we could actually see an individual work 2 jobs and they might show up twice in the survey. And so you can see this kind of long-term trend in terms of non-farm employment, that number of jobs. And you can see that, that had been increasing pretty good. As we came out of that pandemic, we grew at a really good pace. But here recently, in terms of Kentucky employment, that seems to have slowed down. Now, what I'd like to do is move into the next slide. And what we're going to do is we're going to focus on kind of this annual change. So let's go ahead and advance one more time, please. And here what you can see is the Kentucky rate. Now, last year we were basically saying we're going to find 2025 to be more typical in terms of the growth rate of employment than what we had been experiencing since the pandemic. Since the pandemic, we were seeing these really strong employment growth as we were recovering and people were going back to work, firms were reopening. But even as we got beyond that, we were continuing to see some pretty good growth. And it was really just kind of this recovery. A lot of the economic stimulus was being spent, and so that was kind of accelerating the economy. And we basically went into 2025 saying we're going to be more similar to what we'd seen in the past, and that's kind of where we were. The annual total non-farm employment grew in Kentucky by about 0.8%, which is pretty much in line with what we were seeing prior to the pandemic. And if we add the U.S. to that as well, we see kind of a similar pattern. Now, what I'd like to do is even though I said 2025 is kind of similar to what we'd seen early on, I'd like to drill into what has been changing month to month because the story really has changed throughout 2025. So let's go ahead and advance one more slide. And what I'm showing you here with the U.S. is basically the monthly change in employment nationally. And so you can see that this number has really been declining over time. And again, 2023, part of that was accelerated by, the recovery from the pandemic, some of the stimulus spending that was going on. But here lately, what we've been seeing is, less consistently positive numbers and generally smaller numbers. And if we advance one more, we'll see the same type of information for Kentucky. Now, state information estimates, they tend to be a little bit more volatile. So it tends to jump around a little bit more. But if you'll notice, what we were seeing in 2025 is we were seeing some pretty healthy employment growth in Kentucky. Each month we were adding workers typically, but that really seemed to change towards the latter half of the year. And the last 4 months, the data suggests that employment had actually declined. Now, these are really small declines, and they may not be statistically significant, but they do suggest that maybe the trend has changed that the Kentucky economy, much like the US economy in terms of employment, seems to be slowing down. Okay, let's move on to the next slide. I'm going to drill down into a couple of specific industries. In Kentucky, we like to look at manufacturing quite a bit. It's an important category for us. Uh, Manufacturing employment actually contracted in 2025. We did a little bit better in Kentucky than nationally, and that kind of goes back to the national trends. Manufacturing employment in the US has generally been on a downward trend for a couple of decades. In Kentucky, though, we've seen some pretty good growth in terms of manufacturing employment. Even prior to the pandemic, we were continuing to hold employment. In some years, we were able to see some positive growth. But 2025, just because of kind of the national situation, we actually lost some employment there. Let's move on now to the construction sector. Employment has been increasing. And particularly here in Kentucky, we seem to be on some type of a construction boom. This does not appear to be in the housing market. This appears to be more in terms of like industrial type projects. So again, I'm thinking about Blue Oval and the battery factory that Ford was doing. We seem to be seeing a lot of those types of investments. So it's not clear how long this can continue. My expectation is that we'd start to see these projects wind down and then look more like the national trend. Let's go on to the next slide, please. Same type of thing in terms of education and healthcare. And we consistently see this sector grow. It's one that, other than what was going on with the pandemic, you can usually count on very strong, steady growth in this particular sector. Most of this is healthcare. Okay, let's go on to the next slide. And what I'm showing you here is I'm showing you the major industries, same type of data, but just from 2024 to 2025, how did annual average employment across these different sectors change? In Kentucky, we had 4 sectors that saw some declines, including manufacturing, professional business services. Information is not IT, it's more like radio, media, television, those types of things, print publications. We saw really strong growth in terms of construction and education health services. And on the other side, the right-hand side, you can see the percent changes, how we did relative to the nation. So you can see, again, construction, education services, we did pretty good. Construction, we did much better than the rest of the US. Okay, let's move on to the next slide. So one of the things that I kind of want to show you is, what we're seeing in terms of the labor market is we're not seeing a lot of hiring. But what is encouraging is we're not seeing a lot of firing or layoffs as well. And so that's kind of a positive thing that we're seeing here. So let's go ahead and add the next 2 slides or charts as well to this. And what I really want to focus on is the one at the bottom on the right-hand side, layoffs and discharges. What you can see basically is both in Kentucky and the US, the amount of layoffs and discharges is really pretty similar to what we saw in most of 2023 and 2024. So it's encouraging. It's suggesting that even though we're not adding to our payrolls, we're not seeing large-scale declines or I guess mass layoffs. We're hearing about that somewhat anecdotally, but in terms of the overall economy, we're not seeing that yet. Let's move on to the next slide. And this is Kentucky data specifically. We also look at what's going on in terms of unemployment insurance claims. And we had a bit of an increase in initial claims back in October and November. They were up considerably from what we saw in previous years. 2019 is kind of that base year that was prior to the pandemic. 2024 is, the most recent year. But again, what it's telling us is that we're not seeing these large increases in terms of people losing jobs. If we move on to the next one, what we're seeing is what we call continued claims. And with continued claims, the idea is you file your initial claim when you lose your job, and you file continued claims as you continue to need unemployment insurance. And you can see that it's not nearly as high as it was in 2019. Part of that has to do with some legislation. But 2025 is higher than what we saw in 2024. And what this is suggesting to me is that even though we're not seeing a lot of workers lose jobs, it seems to be taking them longer to find new jobs. So if they're losing a job, they're finding or employers are not hiring at the same rate they had in the past, and therefore they're staying on unemployment insurance longer. So it's kind of a signal of some of the weakness that we're seeing in the labor market. Let's move on to the next slide if we could. So here what I'm doing is I'm focusing on employment cost. Now, we don't have this data at the Kentucky level, but our data would likely look very similar to this. And you can kind of see the trend in terms of wages and salaries. And in the orange, you can see benefits. This runs through the third quarter of 2025. And what it's suggesting is that compared to the same quarter last year, wages were up about 3.6%. Benefit costs were up about 3.5%. So again, we're not seeing that same wage pressure we saw in the years following the pandemic, where we had kind of a scarcity of labor and you had a lot of firms trying to hire. That was bidding wages up. That has really come down. And if we advance it one more time, we see similar type of data. Let's go ahead and hit one more time. There we go. We see it across different types of sectors. And so you can see it really varies depending on which sector you're looking at. In the third quarter 2025, the information sector, the leisure and hospitality sector, wages were up less than 3%. Now, leisure and hospitality was one that, if you looked at about a year or two ago, we were seeing some significant wage pressure because we were having a hard time finding people in that sector. That has really come down significantly. One of the encouraging things is when you look at that compared to inflation, which during the same time period was running about 2.7%, on average across these different sectors, we were seeing wages growing more quickly than prices. Now, of course, that's not true for every firm or for every individual worker, but on average across the US, we were seeing most of these sectors were at least keeping up with inflation and actually doing a little bit better. Okay, let's move on to our next slide. Just in terms of our economic outlook, what we're anticipating for the year is we're anticipating that the economy will grow, but it'll grow at a significantly slower pace than what we've seen. We're expecting the unemployment rate to increase gradually as workers who lose their jobs are likely to remain on unemployment insurance longer, take them longer to find work. We're not really anticipating a recession, partially because our GDP growth seems to be so strong. However, we're not really anticipating significant growth in terms of employment. In fact, we might actually see a bit of a contraction, particularly in some sectors. If we move on to the next slide, just some risks to our outlook. The Federal Reserve has to balance inflation and job growth. And the situation we have right now is we have high inflation and we have low job growth. This makes it really challenging for the Fed to get this right. And so it really increases the chances that the Fed might make a misstep here. So getting that monetary policy right is going to be tricky. Move on to the next. The other issue is policy uncertainty. Same issues that I've been discussing for the past couple of years. International trade has been volatile over the past year. As that volatility continues, that makes it more difficult to plan investments. The stricter crackdown on immigration, it's a tricky policy issue, but immigration is a source of labor supply. And so as you restrict that, that's going to make it harder for some firms to find workers. We move on to the next one, please. Well, this is basically what I was saying. This restriction in the labor supply could make it challenging for firms to actually find workers as we move throughout the year. I think that has everything I've covered. I'm trying to watch to see whether there's any evidence that layoffs start to accelerate as firms become a little bit more concerned about their situation. And I'm pretty sure now that concludes my comments. I think I went just a little bit over, so I apologize for that.
That was helpful. So you said at the end that layoffs might accelerate, right?
Well, it's something that we're watching for. It's more of a risk factor. Right now we're not really anticipating these mass layoffs, but there is a lot of uncertainty associated with that. And so, it's something that we're kind of keeping our eye on to see whether or not it starts to pick up. If firms start feeling like their economic situation in their industry, their particular firm is more at risk, then it may translate into to layoffs, and that can kind of snowball.
Yeah. Like we've been living in these uncertain times since COVID. I'm ready to wrap it up and have some certainty for the future.
I would love to do that too.
Yeah. Thank you again for your time. If you don't mind to stick around, we'll have questions here at the end. Incredibly helpful. Evan, you're up. You want to talk a little bit about what we have from the benefit space?
Absolutely. Thanks so much, Kendra. Appreciate it. And thank you all for taking the time to join the webinar this morning. And so my name's Evan Ball. I'm an employee benefit advisor with Bim Group, and we've got offices in Lexington and Louisville, and I work out of the Lexington location. And so thinking about benefit outlook for 2026. And when we're meeting with a lot of our clients, we're often getting questions about a lot of different initiatives that are going on both at the federal and the state level. And so one of the things that's top of mind for a lot of people right now, and we've been getting a lot of questions on, kind of revolve around the enhanced subsidies in the individual marketplace that have recently expired, and ultimately what's that impact going to be for the group health insurance market as well. And so I wanted to just take some time to address, our perspective and what we're thinking about and preparing for 2026 as a result of this recent development. So if you want to go to the next slide here. So ultimately, what's happening right now are the removal of these enhanced subsidies that are in the individual market space. These subsidies were originally enacted in 2021 as part of the American Rescue Plan Act, and they were ultimately extended through 2025 through the Inflation Reduction Act. And the key components around these enhanced subsidies were that they eliminated the eligibility cap from the 400% of the federal poverty level. So previously, people were getting subsidies if they were below that 400% threshold. But by eliminating that threshold there, a lot more middle class families were able to take advantage of these enhanced subsidies. The other thing that was kind of a component of these enhanced subsidies was that premiums were capped at 8.5% of income. So just making it more affordable for people to go to that individual market and take advantage of those subsidies. And a lot of people were seeing, $0 premiums or very low cost premiums for their health insurance coverage through that marketplace. So those subsidies were put in place during the COVID timeframe. They were ultimately designed to be a temporary solution, but have been extended over the years, and then have just been supporting that individual marketplace since inception. But what we were seeing as a result of these subsidies was historic growth ultimately in the individual market. We saw just a significant uptick in the enrollment, and so what we anticipate in the months to come ultimately is just that without these enhanced subsidies, people are going to be seeing their premiums rise pretty significantly, and ultimately millions of people will be dropping their coverage out of the individual market space. But I think one component that I would like to point out here is that the original subsidies are still going to be present, and the government does consider the rates to still be affordable in the individual marketplace, but it's just going to be these enhanced subsidies that are that have been eliminated as of December 31st, 2025. If you want to go to the next slide. So, like I said, it's been pretty well ascertained that millions of people are going to be dropping coverage as a result of the increase in premium. And just since the end of 2025, it's been estimated that about 1.5 million people have already dropped coverage in the individual marketplace. So that is something that we're already seeing on our end. And we do anticipate that that millions more will continue to drop throughout 2026. So when thinking about the impact of this, we're looking at two different centers here that we anticipate seen a major impact here. So one's going to be the health insurance carriers, and then also the hospital systems as far as losing profit as a result of this. So um, as far as the carriers go, they're going to be seeing a lot less premium coming in from these millions of people that are dropping coverage. But also, a lot of estimates are showing that that a significant portion of the people that are dropping coverage are going to be in that younger age category. So typically that 18 to 30 age range. So there's usually a lot of healthy individuals, a lot of good risk in that age bracket. So um, there's speculation that there could be more adverse risk that is going to be associated with the individual market if some of these individuals are going to be dropping their coverage. Ultimately, we anticipate that we might be seeing further increases in premium in the individual market space as a result of these people coming off the policies. If you can go to the next slide here. So for the hospital systems, one of the other things that has been estimated as far as employees or as far as individuals coming off these policies is that a lot of people are estimated to ultimately remain uninsured when they drop their coverage. And so we do, forecast that there will be an uptick in individuals going into the hospital systems for emergency services that are uninsured, resulting ultimately in a lot of uncompensated services. And so, as an impact of that, we're anticipating that we'll see, hospitals trying to make up for that lost profit center through increases in cost of care that they provide for their patients. So we do see kind of some impacts there that will ultimately lead here into the group market space. So as far as the group market space and how these subsidies expiring, people coming off individual policies, how's that ultimately going to impact the group health space? And when we're looking at the group health space, there's ultimately two different market segments: the smaller employer groups, those that have fewer than 50 employees, and those with over 50 employees. And we see the largest impact taking place in the smaller group market, those with the fewer than 50 employees. And the reason we're anticipating that is because the employers with less than 50 employees are not subject to affordability requirements through the ACA. So these employer groups can choose to have their employees cover 50% of their health insurance premiums in this market space. So, in the past, it might have been more affordable for employees to go to the individual market, get that enhanced subsidy, have a less cost for their health insurance coverage. But now these employees might be coming back to their employer to see if they can get a better price for their health insurance premiums. And so if there's not really a great affordable option in the small employer space, we anticipate those employers maybe needing to be a little bit more competitive in that market in order to retain their employees. Because if they're not seeing an affordable option with their employer, there's a good chance that they might be looking at other small employers to see if they might be able to get a better cost, a better benefit through a different employer. So we do see that benefits are just going to be a major incentive in this small group space as a result of the removal of those enhanced subsidies. As far as larger employers go, we by law, the applicable large employers, ALEs, they're required to offer affordable coverage. And so any employees that are with a larger employer likely would not have been able to take advantage of subsidies in the individual marketplace to begin with. Um, so likely it's not going to alter much as far as the existing plan goes. Um, But what we do anticipate on our end is maybe seeing an increase in the applicant job pool for these large employers because we do anticipate individuals from smaller groups who may not have a great affordable option through their employer looking for larger employers that have maybe more attractive benefit options and going to see, if there might be any job availabilities, openings, with a larger employer and take advantage of that. So that is something that we are keeping an eye on. But ultimately, we estimate, healthcare costs will continue to go up. We anticipate health insurance premiums that those continue to go up. And so we find that innovation in the marketplace is going to be more important than ever moving forward. And so that's one thing that our firm is particularly focused on. I'm sure a lot of other benefit firms are focused on as just creative strategies for employers to finance their health care and look at different ways to find stable options for their employees for their renewals moving forward. So whether it's looking at options like ICRAs or partial self-funding or association plans, these are all different strategies that we're seeing employers put in place and are looking into. So that's what we're going to be focused on going into 2026 and just finding those creative strategies that make sense.
So Evan, what I'm hearing you say then is as a small employer, it's going to be more competitive than ever because their benefit plans are going up. And then as a large employer, you're going to potentially have an even larger applicant pool, especially if you have a strong total rewards philosophy with a heavy emphasis on benefits. There.
That's what we're anticipating as a result of, when looking at these subsidies about what might take place as far as those expiring. So it's going to be interesting to see how those two different market segments respond.
Yeah, thank you. Appreciate that. Andrea, a few minutes to share about what the compensation outlook might look like.
Yes. Are you all hearing that feedback? Or is it just me?
Yeah, we hear
I don't know what to do.
You're not in here twice, are you?
I think so.
Doesn't look like it.
Yes, she is on here twice.
Can we kick one of them out?
Right. Is that better?
Yes.
Yeah, perfect.
Okay. All right. As far as compensation goes, I'm with Kendra. I would love for things to be a little more predictable, but we work within what we know. So as far as salary budgets or salaries in general, two opposing factors that we're always having to deal with, and one is you have to deal with the employee side of things to keep them so that they want to stay with your company or that you can hire new employees on. And then you have the other side, which is the budget, right? So what you're making and what you can afford as a company. And so the economy right now, he talked a little bit about inflation, and it's slowing, but it's still up from where we were. That's putting upward pressure on prices. It's lowering the company margins. But what it's also doing is it's creating expectations for employees of, I should get paid more. It costs more to live. Therefore, I should get paid more. On the other side, you have the labor market. We've talked about how there is slower job growth, a little bit of rising unemployment. I mean, those numbers are small, but it's still equalizing a little bit, easing the wage pressures compared to recent years. You talked about how we were above inflation for a while, and now we're getting closer to it. So those are kind of where we're at from a salary budget when you're looking at different things. So unemployment is still low, though. I mean, it's not like we're in the 70s where everybody, is outrageous. So hiring is slowing, and there are fewer people entering the workforce. So it is still difficult, though, if you're looking for some key positions to find those folks. And so you have to keep that in mind when you're looking at your salaries as well, depending on what industry you're in and what jobs you have within your industry that are difficult to find. And again, inflationary pressures don't always equal exactly to wages, but the important part to realize is you have to think about your employees in that their expectations are high. So when they say, going to the grocery store is a lot more expensive, therefore I need to make more money. But, it's an education process as well. And that obviously the company's costs are raising as well. And so there's a delicate balance. So the big thing around that is just making sure you're completely, not completely, but you're transparent with your employees around the ability to pay at exactly the inflation rate when it comes to salary increases. And so again, that's the point of view of, the employees are saying, I am seeing higher costs, I need to make more money. And the company, depending on what industry they're in, saying, we are seeing higher cost as well. So we have to translate that as well, because we have to make money, or if you're a nonprofit, you have to stay within your budget. So, trying to balance those two is the big thing when it comes to coming up with how much you should pay your employees. So again, the biggest takeaway is that affordability versus competitiveness. There are signs that the labor market is slowing a little bit, but there are certain roles that I see over and over and over again that you have to make sure that you're compensating correctly, or you're going to lose those folks, and then you're going to have to hire in new people at a higher rate anyway. So that's always the thing to be cautious of, is don't get too stingy with your compensation based off what your results are, or you might end up making things worse. And so that leads to that third point, which is, used to be everyone just looked at things across the board all the time. Employees, you might have a merit increase, but those have gotten smaller compared to cost of living, as cost of living amounts have gone up. And so differentiate by individual roles within the organization as needed to make sure you're retaining the most important folks within your industry, and market segments. So again, he talked about how construction is doing really well in Kentucky. So the construction groups need to make sure, because there's a limited amount of people to hire within that spectrum, and you don't want to lose folks because they can go over to the competitor for 50 cents more. So an hour, obviously. So those are the things that you need to consider as well. And then lastly, so there was a survey done by WTW. They asked, what are you doing to look at these things that are occurring within the labor market? And the number one response, but it was only 16%, 17%, so still not within, like, everyone's doing the same thing, is adjust your salary ranges and make sure that what your guidelines for pay are for an employee are up to market. And I have done a lot of work with clients recently with making sure that occurs on an annual basis. And if they hadn't done it in a couple of years, we've moved really aggressively the market, because even if you can't pay your folks within that range, to the proper position, in that a 20-year employee might not be above the midpoint, you want to make sure that your hiring rates and that the rates that you're paying people at a minimum are at least competitive with the market. So one thing is to review your salary ranges. And then once you do that, then you want to do a full review of your employees to make sure you can move folks within that range as best as you can, to make sure that the employees with either the highest influence in the organization, or the hottest jobs, or employees that are the best employees, or just the employees who have been there the longest, are not sitting there at the minimum of the market, so that some other company can come and lure them away, which talks to the employee groups as well. So basically, it's all about making sure that you're reviewing what you can afford and making sure that that's as high as it can be so that you're not going to lose people, or you're able to recruit people if you do lose them, with your budget. And then within that, making sure that you're reviewing it to make sure that those employees that are the most important to retain are compensated as closely to market as possible.
Thanks, Andrea. Reminds me of the IT boom we had. I mean, there's been several iterations of them where we might have moved an IT group up 7, 8, 9%, where the overall organization was only at 3 or 4. But now it's not just IT, it's like individual sub pockets of jobs in certain industries. Is that fair?
Yes, definitely. And it's just, it really equated to in the Kentucky, when he was showing the sectors that are having the biggest booms. For a while there, it was healthcare. Like we couldn't find even certified nursing, folks. And people were giving huge bonuses, hiring bonuses to those folks to come on board. That has calmed down a little. It's still important, but there are sectors within, especially even Kentucky, that we're seeing different jobs within the companies that we see that are, you have to really, that's the boom.
Yeah.
And IT hasn't slowed down either. I mean, if you're into cyber stuff, that's a hot job as well.
Well, the only question I have in here is from Rusty, and I'm going to guess that one's an inside joke between Rusty and Evan there. Is there any questions from the group? We've got about 9 minutes before we wrap up that we can entertain.
Oh, this is Lyle. And can you hear me, Kendra?
We can. Hi.
Yeah. I wonder if we've got folks here from E-Town, and Michael, quite a change down there in E-Town with Blue Oval laying off 1,000 people. I wonder if that's in your numbers yet. That seems like a pretty big hit.
Yeah, I don't think they've showed up in our historic numbers because it's my understanding, and I may not have this entirely right, but I think those are layoffs that are going to be spread over the next few months largely. And then I think a lot of them are going to receive some additional compensation. And so that compensation will offset their eligibility for employment insurance benefits, I believe, or at least the amount that they could receive. So they may not actually show up very clearly in our numbers. But, right now that's, one anecdotal piece of information. We start seeing another one and a few more, then it starts to become the issue that we were speaking about. We start looking for, kind of this evidence that maybe employers are starting to get more concerned. In Blue Oval's case, it's not simply an issue of how the economy is doing, though.
Yeah.
It's an issue of how that particular industry is doing. And
right. Just a big shift in that industry caused
Yeah. So some of
plug.
those things might be very specific to policy changes. Whenever there's a change in administration and priorities change, that can change a business model. And that just goes to the uncertainty we were talking about earlier. It makes it really difficult to plan in these instances. And when that planning, when reality starts to deviate from what we had planned, we have to make adjustments, and those adjustments can be painful.
Yeah.
Are there any other parts of the state that you see significant either growth or decline in right now?
It's been interesting. It's been pretty varied. One chart that I didn't include was a county map showing how employment had grown by county. And, I kind of expected, there'd be certain regions of the state that would see declines and other regions that would see growth. Maybe like the urban growth or the Golden Triangle being kind of more growth. And I was concerned that maybe Eastern Kentucky might see more declines, but it was really pretty varied. There wasn't any real obvious pattern to where this, we were seeing declines. And part of that may be because we are still growing at this point in time. We haven't really gotten to that point where we're seeing anything that looks like a recession. We're just seeing kind of a slowdown of that growth.
Yeah.
Wow. I wonder, I'd love to see that by county. I'd like to see what Bowling Green looks like, or Warren County. Seems like they've got quite a bit of activity.
Yes.
Mhm.
But you
Well,
hope
as
that
we
building.
depart here, we'll go to the next slide, which has our SHRM credits. But if you had, knowing that we're HR professionals here, kind of one key piece or one takeaway that you'd like to provide to us, I'd like to go back to each of our speakers. Um, as HR leaders, what do we need to be looking out for? What do we need to be doing right now? I know I'm putting you on the spot. Um, Andrea, can we start with you this time?
Sure. I mean, it was pretty much what I've said all along is that it's a delicate balance between budget and employee expectation. And it's still enough of a wild west out there that your employees can get lured away. And so you just need to be very cognizant of where people are and where they need to be and get them as close as you can to that. Um, and then Evan might pull in a little bit on this too. It's also maybe looking at the balance between what you're paying in benefits and what you're paying in compensation to employees. Is benefits is going to start eating some of that up. Just realize that some people value benefits a lot and some people don't value them as much. So making sure that their compensation for every individual in your organization meets the needs of that. And if you're putting a lot of money into the benefit side, realizing that people that are either younger or healthier, as Evan said, that they might not value that as much and they're going to go where the dollar is. So
You're going to risk it without health insurance for a bit. I think
yeah.
Evan mentioned before. Evan, what you got?
Yeah, I would just say that just as HR professionals, I think it's important just not to settle for the status quo when it comes to benefits, and just make sure you're having conversations with your broker team as far as what options might be available in the market, and just how those might provide long-term stability. Because I think that's going to be the key moving forward is just making sure your organization is positioned to be in the best possible spot for any volatility that we might see moving forward. But there's a lot of really uh, great creative options out there that are kind of coming into the marketplace, and I think there's just some really neat opportunities for employers to take advantage of those. So that would be my word of advice.
Mike, you want to close us out with your words of wisdom?
Well, I don't know if they're wise or not, but I'll throw something out there. Actually, what I think I'd like to do is kind of build on something that Andrea mentioned. And, we've been talking about the economy in general, and we've gotten into a few different sectors. But really, I think the point to remember is that your experience will differ. You need to really understand the factors that are influencing your particular market and how that might differ from the national situation. And so even though we're saying, hey, look, employment, is slowing down, but it's still growing, even though we're saying, wages, seem to be doing this. As we start drilling down into different sectors, you're going to see that those sectors are going to be maybe have more exposure or less exposure to some of the driving issues. Maybe more exposure to the uncertainty associated with trade efforts, if our trade issues, if you are in an international market. If you're in a market that has frequently hired immigrant labor, then you might see a significant reduction in the labor supply. And that might mean that to attract workers, you might have to pay significantly higher wages than what you're seeing the increase in other sectors. So individual situations by industry, by company are really going to vary depending on the circumstances that you're dealing with, the market that you serve, and the inputs that you need to produce your products and services.
The pressure's on. I liked having one playbook for everyone, but I hear you. We have two questions that have come in the chat. I think both of these are for you, Evan. Typical percentage for employer paid benefit package compared to an employee salary. Do you happen to know that? And
Um, I don't know if this is exactly what Tim is looking for here or not. But I would say that as far as like a percentage standpoint, as far as premium goes, I don't know if that might be what he's asking, but I would
I
say
think he's looking at
most.
employer costs, like what's covered from the employer side.
Right, right. From the employer side, I would say that, you know, from our experience, it's typically somewhere between 70 to 80% on the employer side of what is covered. But one thing that's pretty great, and one thing that we do a lot is we have some really neat benchmarking tools. So that if that's ever something that would be helpful for Tim or anybody else, we'd be happy to send over our free benchmarking resources just to see how that stacks up. But if you have access to any benchmarking capabilities, that's a really great way to see how you compare to other employers your size, other employers in the state of Kentucky, others in your industry. There's a lot of different ways you can analyze that, but I would say typically somewhere around 80% on the employer side is what we see.
Is what's covered of the total premium. But when you look at the employee's salary, so you've got their salary and their benefit load, oftentimes we had 30 to 40% on top of a salary to cover for benefits. I think that's the number I
Right.
was looking for.
I gotcha. I gotcha. Yeah, I don't know if I have that number right off the top of my head, but I could dig in on that and get back with you. But I think that sounds reasonable from what I would expect it to be. So,
Yeah, it's what we typically see with clients too, is
okay.
the 30 to 40% mark. Hey, Rusty's got one. What are more innovative things you've seen on the large employer side for benefits?
Yeah. So on the larger employer side, I think it kind of depends on if an employer is set up to be, self-insured or if they're still in a fully insured model. On the self-insured side, there's a lot of different creative things you can do as far as looking at different, pharmacy strategies is really big right now. There's a lot of, high cost prescriptions in the market. So there's different ways to look at, carving out those prescriptions or sourcing those prescriptions from different places, and so there's some different things we're looking at in that regard. On the more of the fully insured side, I would say that there's a lot more association plan options have kind of opened up into more of that large group market space. And I think that there's some great opportunities for employers to find some more stability by being a part of a larger pool of employers there. So,
Got it. To be cognizant of time, I want to go ahead and wrap. Chase, if you'll go back to their contact screen, if you don't mind. If you have any questions on benefit strategies, Evan's contact information is there. Or if you want to shoot us an email, we'll be happy to get it to him directly too. But thank you everyone for your time. Thank you again for our speakers for joining us. Appreciate you all, and I hope you have a great week.
Thank you.
Thank
thank
you.
you.
Thank you, everybody.
Thanks, Lyle.
Thanks, Kendra. Good work.